Welcome to TradeNBA.com. This is John's report is for the 11th of April. Well, it's starting off a little bit soft here in the pre-market, but it's just a continuation of what we had from the magenta moving below yellow at this point, then below the 33, and then that critical pivot when it came back below and then dipped up to the 25, and that's led to the most recent softness that we've seen. It hasn't been anything dramatic. We weren't reading anything from that with the rising gold, but as that begins to flatten out here, it becomes more precarious, particularly as we're seeing a little bit of a spike today starting in NBI white right there, and we've been in this rather elevated area of the orange on the DOC here. Ideally, you want to see it between cyan and red. That's usually continuation mode, and in this particular case that would be to lower. It's slightly outside of it, so that's why I'm not expecting super duper action as far as decline. Short-term buyers have been holding things up pretty decent, but that's kind of flattening out as well, and we're still in a down trajectory with the red and green midterm and long-term buyers, so not very exciting from the bullish standpoint at this particular stage. However, overall, from a bullish standpoint, very well coming off of the balance, given what we're seeing, world economy, market-wise, the problems for the dollar, they're only just beginning. The only advantage is that comparative to the currencies that you're fighting up against, the dollar's going to fare much better than they will, given the choices that they've made in the Russia conflict. Turning to the NQ, NASDAQ, faring poorer simply because there's been a shift towards it, was what we talked about the other day, where the S&P was outperforming the NASDAQ value, cyclicals, things like that, performing better than tech in this particular case. And so it's reaching its 50% retracement off of the initial push-up, and not looking any better as far as the readings go. It's almost identical to the S&P, if not just slightly worse from its practical move, and shakeout being definitely in the negative territory and increasing. The question will be whether we dip below the red line here on the extreme histogram. It's very close at negative 57, so negative 60 we go into the red zone on that, and it gets us close to coming back towards this low right here at the 13.9 range, which was where we first almost got a positive extreme. It was in that yellow category, which is algo activity increasing. We saw that from the S&P as well on that setup. And Euro taking a slight bounce off of Macron. Not doing anything better than they expected, but just not doing worse. So that, from their standpoint, was a positive. But the Eurozone is in a world of hurt with this ruble exchange to oil based in dollar as well as gold, and it's going to have a continuing eroding effect on what the Eurozone is able to do. And so this is where we talk about, as much as people talk about the debasement of the dollar, well, the euro debasement will be faster to the dollar as well as the pound, simply because Europe is going to face the brunt of the fact the policy error on these sanctions and who they're really impacting the most. Really all it's doing is just moving the rest of the world that is in line with the sanctions towards a commodity-based value system of currency, which ultimately is far more ideal than just randomly printing money with nothing other than just your say-so behind it. At least that's measurable and definable, which is something that's only going to cause the ruble to appreciate and probably even aid the Chinese, and potentially even India, oddly enough. So even Saudi Arabia was talking about making exchanges in some of these alternative concepts. And if that's the case, even though Russia is selling a discount to what Brent and everything is selling at, that could start to normalize as it becomes regular. And it hasn't taken them long to make those shifts to other resources. So the effect of all of this is really simply more negative to the U.S. now. Don't even talk about food prices and those futures and what's going to happen as we eliminate. You got to figure most of what we're consuming now was produced from last year's crops, well as this current year is greatly reduced through, there's some geological issues with climate and everything else that have caused certain areas to suffer. But this fertilizer artificial, reduction in the ability to grow as much crop as you want at a reasonable price, that's going to have a big impact coming into the later part of this year as well as into next year as those supplies are completely used up. From a gold standpoint, again, we talked about this too. There's a very small differential between as soon as, if Russia decides to go catastrophic on the West and demand actual physical gold, there's no way with the paper market that they can contain where gold is going to have to rise to should that take place. And I can assure you there's some very worried people about that situation. Oil easing off a bit. Now, this is going to become the question for us to be starting to look at. How much of this drop off in oil in the last few days is because of the recognition of a virtual super slowdown in growth in America, or if it's just the easing of supply restrictions? That's going to be something that really has to be looked at for us going forward. And we're going to, obviously, the market is indicating that some of it is a slowdown. So just keep focusing on what is necessary as far as that goes. And a lot of that's going to be based on this. Okay, so we're at that 125 target that I gave back when we were in the 150s here with TLT and the U.S. Treasury. And the reality of that is simple, that interest rates are going to continue to rise whether the Fed likes it or not in the open market. And that is going to put a strain on credit now as the Fed potentially eases their balance sheet by just allowing flow off of short-term treasuries and that they've bought would be enough to limit the demand. However, you'd have to see a constraint in fiscal spending for that to be of any value. You're not really seeing that at this particular stage. That's a problem. And how that void gets filled is another question. I mean, are they really going to be able to ease their balance sheet, or are they still going to have to keep buying more of their own treasuries because you're losing markets potentially of Russia's not buying treasuries, China is probably going to have a reduction in those. And so this is the problem the ECB has. Who's interested in buying ECB debt? No one. It's all collateralized against itself, and there's really no basis for value there because they're just swapping one debt for another debt in hopes that someone is convinced to pay them money for it, because at the end of the day it's not meeting the interest rate versus what inflation is growing at. So it's like, oh yeah, please give us money so that you can lose money. That's hardly capital preservation. Part of why the market is still holding up, because again, you've got to have some kind of return. Putting it into a treasury and that's so you can lose 7 or 8% for the year is not really a grand idea, given what inflation is running at. Bitcoin continuing its weakness here. It's off another 1,000 here down, but still over 40K. As long as this holds above that 34,000 range, and that I think that it's in good form to just continue to accumulate. Obviously, it just becomes a question of functionality and the ability to be used. And I think that's where you see Ethereum more active from that. Here it is versus the dollar. Again, beautiful from a paint bar standpoint. It's so easy to just see the breakdowns and follow with it. And in some cases, this is the beauty of a futures market versus the actual coin. You don't have all those fees and everything associated with it, and trades in tandem, so it becomes much more effective from a trading vehicle without all the conversions. Now, of course, if you're buying it or whatever to avoid holding on to U.S. currencies or other currencies, that's a different issue. That's not what we're talking about with that. But from a trading aspect, it becomes very powerful to be able to trade these crypto elements in futures contracts. From a 50K standpoint, off the 50K dipping down towards the 0% with the MDI white, riding over magenta. It's holding on to it right now, stayed slightly above that full zero read. Here we have orange caught between that cyan and red, like we talked about, which is a continuation. But when steel popped over it, you're going to need to see that inversion with orange tipping back up and steel coming back down, and that would definitely create a rise. Of course, it's 38%, so easy to dictate that above 73. Long side bias, below definitely to the short side, and just a matter of following those intraday readings. Speaking of intraday, we can look at where the current 5K is, came down from a nice little tight double bottom. It's trying to push back up towards the 50% marker here, but MBI white leading, so a pivot lower of MBI magenta, this particular case, will send it lower and most likely towards that 0% down at the 44.50 range. When we look back at what place on Friday's action, we ended up pretty decent weak side move, which was bought right back up middle part of the day and then eased off towards the end. And that's kind of been a pattern of recent people taking advantage of the dips, thinking that it's a continuation buy, and as soon as that volume comes in and starts to get softer, there's a whole new wave of selling. So there's clearly rotation elements taking place in there, and that's just going to add to the volatility, which was another aspect I mentioned about the Fed. Loves the idea of volatility at this particular point because that will shy people away from the market, which hopefully they believe will move them towards treasuries or just reduce liquidity as far as asset bubble pricing construct. The real interesting aspect is going to be to see how much of an impact home sales. We know that it's going to cause a reduction with the change in fluctuation in interest rates and an uncertainty with potential increased May hike. If you don't see sales jumping here in April with an impending 50 basis point hike coming in May, then you've really got a clear signal that there's trouble in the housing market going forward, because this should be a blowout April in anticipation of that. And if it's not, well, that's easy to tell exactly what's going to happen with that. So a lot of moving parts happening, and we're on top of all of them. As always, though, trade well. We'll talk again later. Look for me on the Skip Chat.